Perfect. So now getting into the charts, what I'm going to be analyzing is first of all, of course, from a higher time frame perspective, like we always do. We're going to start looking into this prime setup, was this USD CAD buys, where not only we have to align our lower time frame perspective, but remember we always have to put time frames like if it was a puzzle, right? So we'll join not only our higher time frame but also our lower time frame or intraday perspective. So from a higher time frame perspective, right now we can see we're in a weekly time frame. We saw that the market, in this case USD CAD, was trending bearish from some time, right? And then after that we can see the market taps in here, demand area. Okay, of course this is a really higher time frame in terms of marking a point of interest, but it's fine just to get a sense of what the market is doing, just to get some sort of perspective of where can we be heading, right? So the higher time frame, remember, is going to stay more for direction and long-term approach, and to swing our position into new levels or retracement levels. So right now what we can see is we have some point in here, lower high, that creates a lower low, comes below this low in here, running that liquidity, and also we tap into this demand level that created a really big push to the upside. Okay, so from a weekly perspective, we could knew before that we were bearish. When we start to go into the daily time frame, okay, again, we don't need to stay too long in terms of a weekly time frame, okay, because that's too many data on there. It's more for direction. And when it comes into the daily time frame, we can also refine our point of interest a bit lower into our demand levels. Okay, and now we can see we have some sort of low that we could run before coming into this sort of daily FU candle where we had this, let me mark it for everyone, equal lows. Okay, run of liquidity FU candle that led to this massive push. After that, we never returned to that FU candle. So now coming into current price action, what do I can see? Perfect. What I can see, first of all, from a daily perspective, as I was mentioning, also on a weekly, this can happen where we're going to get our weekly and daily time frame that sometimes they're going to be sharing the same structural points. So now daily and weekly, both of them were making the same lower high that created the new lower low. Okay, always remember, when the market is overextended to the downside or to the upside, we can expect some sort of pullback. But these pullbacks will come out of a high probable trade if we are coming out of a demand level, like is this case, or if it was the other way around on a bullish scenario and we want to make a retracement of that bullish leg, will have to come from a supply level. But now we're going to focus on this case. So this case, we have lower high that creates a lower low, and after we get this new push to the downside, we also see it's pretty unhealthy, so there's a lot of imbalances during the way. And then when it comes into the new level in here, we have to understand we're going to be buying out of a retracement, so we need more confirmations, not only that we are tapping here, as I mentioned before, on a demand level FU candle, we need more confirmations aligning. Okay, right now we are just building our case on a higher time frame perspective and understanding where our market could head potentially, right? So now when it comes to these demand levels, this is what we're going to be analyzing in here. Okay, I'm going to be breaking down just the buy position, even though we took a couple sells because we knew we were in an accumulation, something that Wyckoff will cover also in a bit, as we're going to be sharing, as you guys know, this video. But now getting into the H4 perspective, a little bit lower, what we can see. We can see how beautifully we create this accumulation type 1, where we have our whole accumulation level with the spring tapping on the demand level. Beautiful, beautiful accumulation of orders. We know institutions were getting out of their selling positions after all this selling pressure, for now start to get into these buying positions to make the retracement that we were speaking on a higher time frame perspective, right? So after that, we know we're in a accumulation type 1. I'm not gonna get too deep into it right now. I'm gonna be more focusing on the structure and the market structure that we had in this position, and Wyckoff later on in this video, he's gonna be explaining more in depth this accumulation, so you guys will have not only the structure view, but at the same time you will get Waqar's point of view on how to read this accumulation in a proper way. So there will be a lot of value on this whole video, so I will highly recommend to stay until the end. That way you guys can take notes of everything. So now, as I was mentioning, H4, we start to see this sort of accumulation, okay, and when it starts to make these bullish moves to the upside, that's when I'm gonna start reading it and explaining it to you guys. What was our thought process in here? So now, first of all, okay, avoiding all the marks that you can see in terms of the accumulation that Wyckoff will explain in a bit. What do we see? So right now we can see how this level in here created a new push, new lower low, right? After that, the market made some sort of retracement into supply levels, and then the market with a really strong push from these supply levels in here. Let me put it in red. Okay, so from here we tap into supply, we see some sort of compression coming into it. Look how aggressive this push is to the downside. Okay, again, don't lose in perspective that we know this is my last point of structural point that came to the downside. So from a structure perspective, we're still bearish, and now the market is coming in here, creating this retracement leg into supply. Now aggressive move into the downside, same thing all over. We come kind of slow, with a slow price action, not really strong into this supply area. Okay, now let's start to get into the replay mode to explain the rest of the trades. Perfect. So now when we break it down into the M15 time frame, we can see how the market, okay, even though we're coming from demand, now we're tapping in supply, aggressive move to the downside, then we get this bullish order flow in here coming into supply, okay, coming from a decisional level in here, demand area that taps, creates a new push, creates a retracement, creates a new push. Now we tap into a point of interest, supply area. Okay, so now what's our trade idea? Okay, this was actually a signal we gave into the community. So this first trading here, this sell position, this 1 to 10, okay, this was a signal between Wally and myself that we sent into Discord. This is something we are not in favor of. We prefer creating the skill into students, creating this thought process that everyone can make this exact same trades that we are taking, just knowing or understanding the WWA methodology in that sense. But again, we also like to share ideas or share some points of interest that we are looking forward to trade for the week. So here and there, also we like to chat with the members and see if we have the same view into the market. So when it comes into this trade, okay, Wally and myself were seeing some, after coming into supply, how the market made a really nice push from here to the downside, okay, creating that bearish push in here, making this break of a structure, and then after that we just give the signal or point of interest in here. Okay, this sell was a 1 to 10, okay, until demand areas in here, and after we tapped into these demand areas in here, we partial out. Okay, our first idea, and this is really important, our first idea, it was, yes, we'll partial out objectively in a demand area, but our personal goal with that sell, okay, it was more to take this into lower levels in here. Okay, so potentially a 1 to 20, 1 to 30 trade. Okay, now fully understanding when Wyckoff covers everything, our potential idea was to sell into demand, to then buy again. Okay, and the buy was gonna be the one that we actually wanted to take long term, okay, as a swing position, because we were understanding this full accumulation in place. Okay, so this position was more intraday in that sense, expecting this sell from here into demand levels. Also, this is the importance of the community. Okay, inside this place in here, you guys will see that I took not only this first sell, I also took this second sell, and I took even a third one the next day. So what do I mean about that? The important here is I cannot get into too much detail in YouTube, but when it comes into the community, I love to do calls like this one, when I will break not only the understanding of this sell, but I will also show how I was managing my positions into the trade. Something really important, something really powerful to be when you are part of the community, because taking the trade is beautiful, it's amazing to get into the position, but also how are you managing your trades? How are you actually holding that volume into objective levels? So from here, again, I was selling into here, closing into demand objectively, and then when it comes into here, I will show you guys also in a screenshot that will leave in here. I was also selling from a point in here, second trade, okay, into here, then again partial out, then it comes back, I sell again from here, okay, so I had 3 positions selling this, okay, that way I was just partialing out, but at the same time leaving a really good volume into it. As I was mentioning before, my goal was to come potentially lower, okay. Also, something really important is not also taking the trade, as I mentioned, is managing the positions, but also we can have a potential idea in place, and that's perfect, but also we have to be understanding what price is telling us, and we have always to be adapting to price action and adapting to what the market is telling us. So in that sense, so I'm going to show you guys how after these 3 sales that I'm mentioning, that I was potentially looking for here after partialing out in here, I also changed a little bit my bias after the price action that was developing in this area. So I'll end up taking a buying position to hedge my 3 sells. Something really important for you guys, majority I think of you guys have been watching our previous videos, and my previous videos were was a USD CAD, a euro dollar trade. In all of them I explained the importance of hedging at key levels. Why? Because in ideas like this one, when we know the potential is huge, like this trade that ended up being a 1 to 75 plus, okay, we have to understand that if we are in sales that are 1 to 10, 1 to 10, 1 to 15, or 1 to 5, something like that, this potential buy adapting to current price action ended up being the play. And my thought process at the beginning was to buy from lower levels, but then after being in the sell and covering myself, I say, okay, price action is telling me this, let me adapt to it, let me risk some percentage in the table, let's say 1%, which is what we usually trade, okay? And from here, if for any reason that in this case didn't, price action does not want to fly from here, from this point of the accumulation, and wants to come a bit lower, my selling positions in here that still had like really good volume will cover the loss. So that way, when we are formulating our idea, I'm understanding where the sell is coming from, where potentially the buy can come from, and where potentially I can be able to risk some percentage again, because market or price action is telling me or showing me some bullishness intent to go to the upside. Okay, so now I'm going to leave Wyckoff explain the whole accumulation so you guys can get a full perspective of it. And then just to finalize the video, I will jump in again and just break down this last buy in here. Was, as I already mentioned, it was a hedge position of my 3 sells. So 3 sells ended up with the buy that potentially we actually wanted to take into these higher levels in here.
Hey guys, sorry to interrupt this video. I didn't mean to quite hijack it the way I have, but I wanted to come on and give a brief overview on the Wyckoff elements of this trade. Now, Alex has already given you a brief overview specifically of the sell signals that Alex and Wiley gave into the community. And again, high risk to reward, high precision, high confluence in place. But the overall thing was that was a sell to a buy. And Alex is going to go on to cover the buy. But before he goes on into the details of all of the aspects of why we got into that buy in terms of lower time frame, in terms of timing, in terms of liquidity, all of those lower time frame characteristics that we show, I want to give you guys a bit of a macro overview of the higher time frame, specifically when it comes to the schematic that was playing out over here. It was a type 1 and accumulation. Now, when it comes to Wyckoff theory, there's a lot of things going on in the industry at the moment. Some people are swearing by it, other people are saying it doesn't work. It's coming a new trend. Over the last year, I've seen a lot of people picking up upon it as a new holy grail. And I want to say Wyckoff theory is certainly not a holy grail, but it has its place. When it comes to the way we trade, it's about 20% of our strategy, but you have to know more so the story behind it and the the nuances and the details of the characters of what is going on within a schematic, what is the purpose, what is the goal that they're trying to achieve. And if you can read that story moving forward, not only can you buy and sell within the schematic, read the intentions of the composite operator, you can actually catch the accumulation with the composite operator, and that's obviously what we want to be doing. Therefore, it exists, it has its place, but it's not the be all and end all. And specifically when it comes to a lot of people I see in the industry, a lot of new people, when it comes to Wyckoff theory, they try and label everything as a schematic, meaning what's the difference between lower low, lower high, lower low, lower high, lower low versus selling climax, secondary test, spring? In actuality, there is no difference until after the fact, in hindsight, when you're looking at the schematic. So now the challenge becomes is when a schematic is defined, when it is complete, when phase E has happened and you have the expansion, how are you supposed to preemptively know during the spring test phase B to D within these areas, if you want to be buying with the composite operator for that expansion, how can you preemptively buy when all you see is lower lows and lower highs? That's when the challenge comes in, and that's when the characteristics of reading the details, reading the story, understanding intentions and understanding liquidity. And that is what is so important about Wyckoff theory. I don't really concern myself, or we don't really look at, the arbitrary units of, secondary ST in phase A, ST in phase B, spring test, what do they all mean? Okay, it's just terminology, it's just semantics, but what is actually more important is the underlying intentions, and that's what I want to go over with you guys really quickly today before I pass it over back to Alex. So before I get into the trading view and actually show you specifically what was happening in USD CAD, I'm going to come to my iPad and give you a bit of a brief overview and what I'm seeing in terms of a generic schematic and the intentions I'm referring to, and then we'll come onto the live chart of USD CAD and show how it goes from theory to reality. Now, as we can see on my iPad, what I have over here is, first of all, a schematic of an accumulation that you can Google this. It's probably the first thing that is going to come up, and this is the most famous one that everybody is using. Now, what am I actually specifically focusing on? I'm specifically focusing on traps. Now, what I mean by traps is where the average retail trader, where banks and institutions, where they are going to lose money, where they are going to be taken out of the market, specifically speaking, where are their stop losses? Now, when it comes to retail strategy, everybody, baby pips, YouTube, books, textbooks, literature, even in banks, what are they trading? They're trading trend lines. Everybody knows about a trend line. Everybody knows about a Fibonacci. Everybody knows about EMAs. Everybody knows about an RSI. All of these very common things. It's no secret people are using it. So if we come into the market and now we try to see a trend line as an edge, or a Fibonacci as an edge, or a holy trinity of Fibonacci, EMA and trend line together, yeah, it might work at times, and in hindsight it certainly can work. You can drop a random line on the chart and you're going to see it's a support level, but again, it's just arbitrary. The same comes with these kind of things. What more so I see that is liquidity, because a lot of people are going to be entering here, retail traders and institutions alike. Their stop losses are going to be placed very intentionally in these areas, and therefore for the composite operator, for institutions that are accumulating, they know exactly where those stop losses are, and therefore exactly where they need to move price to take that liquidity. And that is the key, because liquidity drives price. And a very famous saying, our favorite saying over here is, if you cannot see the liquidity, you are the liquidity. So I'm going to show you guys where the common liquidity traps fall. So right now, as I was referring to previously, I'm going to do it in red to show you bearish. Lower low, so lower low, lower high, lower low, lower high, lower low, lower high, lower low, higher high. So if you're just always guessing that these drives to the low is suddenly going to lead to a bullish market, you're going to take a lot of losses, because you need to understand you're in a bearish market trading counter trend if you are looking to buy. Therefore, you need to have a lot of confluences laddered in to justify why you are buying in a seller's market. Now, when it comes to the liquidity and the details within, this is what I want you guys to start to notice. I'm going to zoom in a little bit on phase A and B. So in phase A and B, there's a lot of interesting things going on. I'm going to move on to orange just so you can see it a little bit more clearly. From, let's say, this point, we have a trend line forming. And then when price comes here, people are going to be selling, because we're in a bearish market. They see a trend line, a third touch of the trend line from swing high to swing low. This is their Fibonacci area. So we have trend line and Fibonacci confluences. When they are entering, their stop losses are going to be right in this area. They are selling upon a touch of a trend line, stop losses right above. Now, when price comes to there, it gives them their play. It gives them a small reaction to say, hey guys, you're doing the right thing. They're going to get happy. They're going to see a bit of profit, and then stop loss. They're taken out. Look again over here. Let's do it in green. we see 1 touch, 2 touch, 3 touch. We are seeing a trend line. We are seeing a new bullish internal trend playing. Then price gives them a little reaction here and then takes them out. Their stop losses obviously were in this area. Let's come to another one. We have 1 touch here, double touch here. What do we see that as? Liquidity taken out because their stop losses were right below that double bottom. Another one here, 1 touch here, another touch here, liquidity taken right below. We have another one where we have 1 touch here. People saw that was a reversal point. Price comes back to that reversal zone, stop loss is taken out. So we can start to see all over the place we have liquidity traps. I've marked them out as inducements. And we can see there's different types of inducements. That's something we teach in our advanced bootcamp, Liquidity Inducement Theorem. What is a medium, minor, and major inducement. But we can see that we have liquidity traps all over the place where I can name one over here, another one over here, another one over here, another one over here, another one over here, the major one over here, another one over here. Price action is littered with price accumulation is where you have the composite operator trying to take out sellers and trying to take out weak-handed buyers. And how they are doing that is they are enticing them to come into the market and then taking their stop losses so they are out of the market. Again, remember the goal. What is the goal of an accumulation? Or what is the goal of any schematic? It is to take out, in the sense of an accumulation, to take out weak-handed buyers and to take out sellers. So that is what is going on. The accumulator is slowly playing that game of chess strategically, enticing people to come in, taking them out, to make sure that the lower that the price comes, the more inclined the sellers are to take profit, and the lower the price comes, the more they can ladder in their buys. So that is what it is like in theory. Let's quickly come on to TradingView, where I can show you guys a little bit further on what was happening exactly in USD CAD. So guys, as we can see on the screen, we have the higher time frame, the 4-hour time frame of USD CAD, the trade that Alex was covering. So previously speaking, coming into this trade, we cannot know if it is going to be bullish. We cannot say it's going to be an accumulation. Why? Because we are just seeing lower highs and lower lows. Lower highs, lower lows. We're just in a bearish market. How can we possibly conceive that we are going to be bullish? Well, that's where you need to start to notice the details. That's what I want you to start to understand. I'm going to quickly come to the 2-hour time frame, just so you get a bit of an overview. Let's start with the liquidity traps I was referring to on the iPad. First of all, we have this trend line forming where we have 1 touch, 2 touch, 3rd touch. People are going to be entering over here. Why not throw on a Fibonacci? See what else is going on from swing high to swing low. Okay, we have our 61.8 perfectly lining up with our trend line. So we can start to see retail traders will definitely be looking to sell here, and institutions alike, because they follow a very similar strategy. They're going to be selling here because they have a downtrend, they have internal bearish structure, they have the trend line, and they have the Fibonacci confluences. They get taken out, so their stop losses are taken out. So those sellers are now exiting the market, meaning the composite operator, the buyer that wants to be accumulating, is now remaining within the market and taking out slowly the sellers. Let's move on to see another example. We can see we have an internal trend building up over here. 1 touch, 2 touch, and then they are taken out. This previous support level taken out. This internal support level, this double bottom, we get a small touch over here. We get that small reaction. Let me zoom in so you can see a little bit clearly. Where we have support level, double bottom, price comes once again, gives them that small reaction, gives them that hope that this is working, and then they are taken out. So their stop loss is taken out. We can see price is littered all over the place with examples like this, where we have double top, price comes here, liquidity taken out. We have a trend line case over here, where we have 1 touch, 2 touch, 3rd touch, taken out. So why are all of these confluences that we are taught, trend line, Fibonacci, etc., support, resistance, blah, 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 all of these things play out, fail, play out, fail. Reason being is because they are enticing. The composite operator is enticing you to come into the market, following the retail strategy that is available to everybody, and then eventually taking you out of the market. So you think, okay, I had a little bit of profit, or it works before, I just took a loss this time, and it keeps you, with a fishing rod, it keeps, or the carrot in front of a donkey, it keeps enticing you to come again and again. It's just out of reach, and you think next time will be my trade. And that's kind of the goal with what the composite operator is trying to do, is trying to take everybody's liquidity and make sure they are the only participant left in the market. Over here, we have a resistance level, price shoots up and then comes lower. You start, okay, this is the real reversal point, and then we have what potentially is, as we teach in Liquidity Inducement Theorem, a smart money trap, where we are taking out the smart money play. So it's not just retail traders being targeted, it's every strategy being targeted, because that is what the goal of the composite operator is to make sure everybody loses money apart from the people controlling the markets, or the participants controlling the market. So again, I'm not going to go into too much detail of why I consider the schematic forming as we did. Again, that's more so for students, but what I want you guys to focus on is we had drives to the low, where we are testing lower and lower in demand. What does that mean? The lower we come, the more inclined the sellers are to take profit, and the more inclined buyers are to enter the market. And then the spring, obviously, to take out the weak-handed buyers, because that is the final play, is that major inducement, is that ultimate FU candle, to make sure everybody is taken out of the market except for the composite operator. And that's when we have the change in character, and that's where we continue bullish. So we have our spring, and then we have our equal highs. That equal highs is a liquidity target. That is where price is magnetized towards. Then we have the test and mitigation, and then we have a bullish push. So we can start to see from that point onwards where we have our spring, and then we have equal highs. So we are still bearish at this point. Then we have a higher low, and then we have a bullish break of structure. So we know that something within this leg, that's the leg we identify as our important leg, somewhere within this leg, we start to see where's our decisional points, where are our price reversal zones, where are our points of interest, and we start to refine these areas, start to see reactions, start to build our case based on intentions, to see when is the buyers ready. And look, even though we had the test and the higher high, we are still maintaining this bearish order flow. We are still maintaining bearish price action. So we didn't jump to buy. We actually gave sell signal over here to the community. We are, hey guys, this is where we're looking to sell. We gave them the entry points, and this is what the community took. They played out to a nice risk reward, and then we decided to buy because that was the main goal. Selling in case the accumulation fails, but the buy being when the accumulation plays out, because that's the signs we are seeing. And then look, right after we enter the buy, the accumulation started to complete. We have our final phase of phase D, where we have our sign of strength and last point of supply over here, and then we get strong bullish reaction. We get strong bullish expansion. Why? Because we had a successful accumulation. What is defining a successful accumulation? It is where there's a low resistance environment, where the weak-handed buyers and the sellers are out of the market, and the only participant left in the market is the buyer that is accumulating. So I'm going to pass it back over to Alex. So, because again, this isn't my video, I just wanted to jump in and give a little bit of an explanation on this side. But Alex is going to cover for you guys a little bit more in detail about this buy and how it initially started as a hedge, because we had lower buy entries where we had our test, we had this order flow point, but when price reacted from here, how it ended up being the main position, how we managed it, and again, how the entry came about. So guys, that's enough from me. I'm going to pass it back to Alex. But yeah, if you do have any further questions, do let me know in the chat box, or do contact us on Instagram. Last point from me. A lot of these details we will be covering within the call bootcamp. We actually go over all of Wyckoff theory in the bootcamp, and also how to identify the retail traps, how to identify liquidity, how to identify areas where you're combining structure with smart money with Wyckoff theory, and that's the core concepts. But something we've recently started to teach our students is liquidity inducement theorem. Now, liquidity inducement theorem is a new curriculum we came out with not too long ago in collaboration with community members. Raim, who was originally a student, shined in the community, and in partnership with him, we have created liquidity inducement theorem. Just to very briefly touch upon it, this is where we cover more in-depth, advanced price action within the daily cycle of what is happening through Asia, what is happening through London, what's happening through Frankfurt, what's happening through New York, how we can combine the confluences of, for example, Wyckoff theory, how we can combine that with smart money, how we can combine that with smart money traps, how we can combine that with liquidity, as is in the name, liquidity inducement theorem, as I showed you in the iPad in the beginning. Where liquidity lies, then you have an inducement. So we cover all of these things in extreme detail to help our students understand, from the bootcamp, who have understood higher timeframes, who have understood structure, who have understood the core concepts, to now start to specialize more in depth on an intraday perspective. But yeah, that's enough talking from me. It's been a pleasure, guys, and I'll catch you guys in the next one. Back to Alex.
Perfect. So now, after Wakkar's explanation on Wyckoff and this type 1 accumulation that he was explaining beautifully, and he added that point into this video, now you guys can see that it's great to have both perspective and the merge of those school of thoughts, not only Wyckoff. So you guys can see how we are merging school of thoughts together, not only Wyckoff, as Wakkar was explaining, but also market structure, supply demand, higher time frame, remember, for direction and proper understanding of where the market can be potentially heading on a higher time frame perspective, as if we know we are going to be making potentially a continuation, or we're going to be potentially making a retracement. All these things are really important to make our whole case or our whole trade idea. So now in this case was a bearish market in terms of a higher time frame perspective, tapping into a demand level. Then we add the Wyckoff accumulation that Wakar, as I mentioned, already explained. Then we add our market structure in place inside the accumulation level. And now with all this intent and having this perspective or this trade idea into the head, let's get into the last buying position that, of course, you guys remember from the previous video. That, of course, you guys remember from a couple of minutes ago before Wakar jumped in. I was explaining that, yes, potentially we wanted the sells to go into lower levels. Okay, let me show this. Take this out first. Okay, let me show this. So as I was mentioning before, we had 1, 2, and 3 positions that we'll show here on the screen, and that we were partialing out objectively on demand, but potentially we wanted to come a little bit lower. But at the same time, because we knew all these confluences or all this trade idea was formulated from before, understanding the accumulation, understanding that we're coming from a higher time frame demand, understanding that from a higher time frame perspective we just created a new leg or new push to the downside, so we can expect some sort of retracement. Institutions are building orders from the selling pressure to now the buying pressure with the accumulation. We knew we potentially had a really good trade coming in place in terms of the buys, right? So now this is when we have to adapt, even though my idea was from a lower level. And after all these confluences in place, I started on the M15 time frame, which is more an intraday perspective. In terms of intraday trading is way more harder than swing trading. This is something that we've been teaching now to students in our lead bootcamp with Raim, Wakao, Wally, and myself, so they can properly understand not only the swing perspective, that can be also really helpful, but also understanding such important things like liquidity in depth or the daily cycle, or all these things that are gonna allow you also to have a better entry for your swing trades. But also, if you classify yourself more as an intraday trader, can be really helpful to get those positions in and out for the session, and that can be really helpful. So in depth in terms of what was the daily cycle, I cannot get too much in depth of what was the daily cycle in this case, but I can break it down from a demand perspective and our intraday entry based on an M5 perspective too. So first of all, as I was mentioning, not to repeat myself too much, 3 selling positions going into the downside, partial out already, and now when we're coming into this demand level, we have all this price action in here. It does not have a lot of volume in terms of selling pressure. We can see the difference, for example, between this move in here from this point to the downside, where we have a really quick move, understanding that there's a lot of volume being injected in there. But then if you can check this, we have more like some sort of consolidation or not so much selling pressure. So after that, looking on the other way around, what do I can see? I see that the other way around, market retraced or moved really quickly to the upside into this supply, giving me some sort of point of interest based on smart money concepts, right? So when I get this point of interest in here, and I'm already in these 3 cells, okay, I understand I want it from lower, but I have to adapt to current market or price action, and what is price action telling me. So after that, I go into even more intraday time frames like the M5, okay, and then coming into this trade, we tap into some sort of demand based on the M15 point of interest that I previously mentioned. And then when we come in here, what can I see? After that, I can see how we have liquidity in here, how this was run by this candle in here. And after that, what can I see? Really nice intent. Okay, really nice intent of that gray bullish candle into the upside, showing me that after running this liquidity, after coming into this M15 point of interest, we can see that momentum changing, okay, at the difference between all this consolidation movement, now this intent to the upside, and now just our trade was entering there. Let me just put this properly so you guys can follow. entry in the stop loss below that candle, and then remember our targets are based on a higher time frame perspective, are based also on the full accumulation taking place, and this ended up being a 1-2, so you guys can see a 1-to-100 trade. Okay, really important when I'm formulating the trade idea, not only is important the entry, it's also really important to understand where I'm gonna be taking out my trade. So if you guys of course remember from the beginning of this video, something that we were mentioning, let me go to H4. Okay, something that I was mentioning is from a higher time frame perspective, okay, daily, weekly, that's my main push to the downside. Okay, lower high that created my lower low. This whole accumulation in place based on a demand is to make some sort of retracement. That's my trade idea. So once I make a 1-to-100 trade coming into these supply levels in here, from a daily perspective, you guys can see even better. That's my last pressure of a buying candle before we go into the downside. So that's my retracement. You can see beautifully how we have lower high, lower low, accumulation of orders in place. We're buying this trade 1-to-100. My trade is out. It's really important to have objective levels where you can cut your trade or just fully get out of your position. Okay, why? Because watching this, okay, maybe or potentially the market continues to go to the upside, but now that's out of my trade idea. If for any reason we break this high and then we keep going to the upside, there will be more opportunities to then capitalize on and then adding entries into that bullish market now. But for the beginning, my trade idea is based on this bearish push, accumulation in place coming from demand, retracement of my higher time frame, okay, in terms of the daily, weekly, but of course my lower time frames were bullish. So now when I come in here, trade is done, 1-to-100, beautiful trade. And remember, a lot of things were merging in place, is coming from a demand level, higher time frame giving us the direction of bearishness and then potential retracement, accumulation type 1 in place, intent into the intraday or lower time frames basing out of M15 and below, and then daily cycles and more intraday liquidity and all these that I cannot get too much in depth in here, but hopefully you guys took a lot of value from this video. Let me know in the comments how was it, what did you guys learn from this video. So if you guys want more videos like this, just show us support, like the video, subscribe, comment anything that was helpful for you guys, and we will be providing more videos like this one. So see you in the next one.